Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and a warm welcome to Money Talk on Wednesday the 3rd of May. I'm Peter Lewis. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the International Monetary Fund has raised its growth forecast for Asia Pacific, predicting the region's GDP to expand 4.6% this year, which is 0.3 percentage points higher than its forecast in October. It expects China and India to contribute around half of global growth this year, with the rest of Asia Pacific contributing an additional fifth. That would mean the region would contribute around 70% of global growth. Hong Kong's economy expanded 2.7% year-on-year in the first 3 months of 2023, following 4 consecutive quarters of contraction. The latest data was unexpectedly announced by Hong Kong Chief Executive John Lee at his weekly press conference on Tuesday, and beat economists' forecasts of a 0.5% expansion. It was also a big improvement on the 4.2% contraction seen in the fourth quarter of 2022. The Reserve Bank of Australia unexpectedly increased its cash rate by 25 basis points to 3.85%. That's the highest level since April 2012. Economists had expected the central bank to keep rates unchanged again at 3.6% as inflationary pressures ease from elevated levels. And more than 159 million trips were made by car, rail, aeroplane and waterways on the mainland over the first 3 days of the 5-day Labour Week holiday, which ends today. That's up 162% from the same period last year, according to data from the Transport Ministry. And China's Ministry of Commerce reported major retail and catering companies saw sales expand 21% from a year ago. On today's programme, I'm joined by our regular Thursday commentator, Enzio Von Pfeil, and Will Denyer, US economist at Gavekal. We're also going to talk about Asia's frontier markets with Ruchir Desai, fund manager at Asia Frontier Capital. If you want to get in touch, please go to my website, which you'll find at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Tuesday, US stocks fell for a second consecutive session on soft jobs data and further concerns over regional banks. The S&P 500 slid 1.2% and closed at 4,120. The Dow fell 367 points, or 1.1%, to end at 33,685. The Nasdaq Composite dropped 1.1%, ending the session at 12,081. The rescue of First Republic failed to halt the slide in regional banking shares. The KBW Regional Banking Index tumbled 5.5% to its lowest level of the year. PacWest, seen as one of the weakest of the mid-sized regional banks, was briefly halted before closing almost 28% lower at a record low. Western Alliance was down more than 15%. And Utah-based Zions Bank was the biggest faller on the S&P 500 index, dropping almost 11%. JP Morgan Chase's shares slipped 1.6%, giving back some of its gains from the previous session. Hong Kong's Hang Seng initially rose as much as 2%, but gave up most of those gains to end the day just 39 points, or 0.2% higher, at 19,934, as weaker than expected manufacturing PMI data on the mainland sowed doubts over the strength of the nation's economy. Futures markets are pointing to a decline of 277 points for the Hang Seng. That's 1.4% when trading starts this morning. Yesterday, the tech index fell 0.1%. And mainland China markets are closed until tomorrow for the Labour Day holiday. Shares of HSBC climbed 4.5% in Hong Kong after it reported pre-tax profit jumped by $8.7 billion to $12.9 billion in the first quarter, more than 3 times the figure from a year earlier. It was boosted by a provisional gain of $1.5 billion on its acquisition of Silicon Valley Bank's UK arm, which it bought for a nominal £1. HSBC also said it was launching up to $2 billion of share buybacks and a 10-cent per share dividend. That's its first quarterly dividend since 2019. And elsewhere in the markets, oil prices slumped a day after OPEC Plus began its latest cut to production. Brent crude oil fell 5% Tuesday to $75.32 a barrel. That's its lowest price in more than a month. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us our regular Wednesday morning commentator, Enzio Von Pfeil, who is a capital preservation specialist for individuals. Morning, Enzio.
Morning, Peter.
And also with us, Will Denyer, who is US economist at Gavekal. Morning, Will.
Good morning, Peter.
Well, the US Federal Reserve set to raise interest rates by 25 basis points tomorrow morning Hong Kong time, with two key gauges now showing persistent US inflation pressures in recent months. According to the CME's FedWatch, traders are pricing odds of 85% of a quarter of a percentage point hike. That will take the Fed's funds rates to a target range of 5% to 5.25%, which is the highest level since 2007. So, Enzio and Will, we know what's going to happen. We're pretty certain what's going to happen tomorrow. The key is what's going to happen afterwards. Markets seem to disagree with the Fed. The Fed seems divided itself over where it goes next. What do you think?
So the Fed is first and foremost an inflation manager. That we know. Now, the Fed has changed the way that it looks at inflation in recent years. Before 2020, it was largely a forward-looking inflation targeter. Inflation expectations in the market as well as their own mattered more than trailing inflation numbers. Now, that has changed, at least on the margin, since 2020 for two reasons. First, the Fed actually changed their target to an average inflation target, which means by definition they have to incorporate trailing inflation numbers into their policy decision making, as opposed to before it was a bygones policy where they were always just looking at inflation in the future. Whatever they missed in the past was, let bygones be bygones. And the second reason, and perhaps the more important one, is that the Fed got its inflation target just horribly wrong in 2021. And so now Powell and his economists basically have egg on their face and need to restore the confidence of the market in the Fed, restore the credibility of the Fed. And they frankly just probably don't trust their own inflation forecast. And so Powell is very much in a, show me, don't tell me inflation is coming down mode. And it's understandable why. And I agree with him that getting the Fed's credibility back in shape is critical. However, this does increase the risk if you are more of a backward-looking than forward-looking inflation targeter, that you stay too tight for too long. And I think that is, you take that increased risk combined with the fact that we had exceptional policy stimulus for a couple of years, and we had some massive changes in the way people consume and work, and so the economy is shifting to that new normal. You combine extreme stimulus with extreme and perhaps prolonged tightening and major changes in the economy, and then to think that we're going to come out of that with either no recession or a mild recession, a soft landing or no landing, to me feels like wishful thinking. I do wish that. I do hope that's the case. But to me, I'm in the hard landing recession camp.
Enzio, we're not too tight yet, are we, though?
Start again, Peter. Sorry.
The interest rates, monetary policy isn't tight yet, is it?
I think it has a long way to tight, and the quantitative tightening get about 8.222. I don't proclaim to be a monetarist, but it just seems as that's when the balance sheet shrinkage began properly. And I think also the second tightening is going to be very much because of the private sector. I think that the private banks, especially the smaller guys, the ones that again are under the gun, are going to be putting the reins in on their credit lending, especially to the property sector. So you will have a private sector tightening along with a Fed tightening. And that again ties in with where I would agree with Will that the recession, the landing, is really going to happen. It may not. It's not happened yet. We kind of figured that one out. But I don't defy logic that if you have an excess demand for money, in other words, throttling of money supply, throttling of credit growth, I don't see how economies grow off that. So I don't think this time it's different.
Will, do you think we're too tight at the moment, or has the Fed got it about right now?
So I don't know. I think if I was the Fed, I would. I say I don't know for sure. I actually think that policy is quite tight between short rates. I do think are quite high, especially relative to inflation expectations. Now, if you look at it relative to trailing inflation, real yields don't look high yet. But I think what matters is forward inflation expectations when you're deflating yields. If you look at all the yields in the economy, whether it be return on invested capital in the corporate sector, equity earnings yields, bond yields, if you compare real yields at the short end of the curve, which is what the Fed is most directly controlling, they're extremely high on a relative basis compared to the past. I mean, every time we've seen them this high relative to all those other yields in the rest of the economy, we've had a recession. And then at the same time, the Fed is contracting its balance sheet. And so we've actually had an outright contraction in the money supply. So, some people say, well, okay, it's a mild contraction in the money supply after a massive increase in the last few years. Doesn't that mean that kind of on net we're still in positive territory? And to me, they're actually additive on the negative side. The fact that you had so much easy money and cheap credit for a couple of years probably started a bunch of economic projects that are not viable at higher yields. And now that we have money supply contracting and real yields higher, I think a lot of those unsustainable projects are getting downsized and will eventually fail. And of course, we're seeing some banks getting into trouble as well. And so I do think they're tight. As far as answering the question, I totally agree with Enzio that on top of the policy tightening, the stresses in the banking sector, and probably every bank out there is kind of rethinking their risk management. Every bank regulator out there is calling up the banks and saying, let's rethink our risk management. And so banks were already tightening their belts, tightening lending standards before SVB, First Republic, and Signature Bank blew up. And now they've got to be tightening even more. So I totally agree there. Now, I haven't actually answered your question at the beginning of where Fed policy is going from there. I've kind of given my view on what Fed policy is likely to do to the economy, and I think that's necessary to now answer your question. Crucial. Very clearly, they're going to hike, as you said, tomorrow. Given that they are backward looking, I think there's a risk if inflation continues. I mean, right now it's coming down, but very gradually. There is a risk that they continue to keep hiking rates until they are convinced that inflation really is trending down. Personally, I think they should pause and just kind of let the existing tightening work its way through the system and see what happens before they keep going. But given the context that I just explained, there is a risk that they keep hiking. As far as the balance sheet contraction, which there has been less talk of, but I think is important, I think we're actually getting close to the end of quantitative tightening. When the Treasury lifts its debt ceiling, it's going to suck when Congress lifts the debt ceiling, it's going to allow the Treasury to issue debt and suck up a bunch of reserves from the system. When they do that, by my estimates, that is going to bring reserves in the system down to the range that I think the Fed is probably guesstimating is around ample, which is the goal of quantitative tightening. So after that happens, I think we'll probably get either a tapering or an outright end of quantitative tightening not long after that.
Enzio, isn't it? Markets, investors, they're looking for some sort of guidance here. Isn't the problem, one of the problems anyway, and one of the reasons maybe why the Fed is in some difficulty is that it seems to have given up giving any sort of forward guidance. I'm sure Jerome Powell will be asked at the press conference tomorrow, and as usual, he's not going to give any indication about whether or not we're close to the end of the cycle, whether more rates are coming, what it is that will decide. He'll just say we're data dependent. Isn't that a problem? Shouldn't the Fed try and give some more guidance as to what's guiding its thinking?
Of course, but I think it's so anachronistic in the way that it looks at inflation. It looks at it very much in a purely monetarist, too much money chasing too few goods, demand side equation. I think there's a lot of supply side mess going on that is not being factored in. The only one who's talked about this ever in my reading of this, spotty I will admit, is Janet Yellen. But I mean, we've got sticky inflation from the supply side, food, the El Nino, La Nina in Argentina, which accounts for about 40% of soybean and meals exports, 8% of global wheat exports. Well, food prices will remain high because La Nina is not going away. Labor, people don't want to work in the jobs beneath them, so up go the prices of menial labor. Surprise, surprise. Oil, forever an unforecastable political football. Rare earths and metals, again, because of the structural change in the move to electrical cars and all this ESG movement, you'll find that those prices will remain high. So I think it's the part of the reason that they're not forward-looking is because they are very anachronistic in the way that they're looking at inflation. They're not being holistic. They're only looking at demand-driven, not supply-side-driven inflation.
What is the risk that we get something worse than a recession and we get stagflation? And the reason why I ask is I'm looking at the ISM manufacturing survey, which came out this week, which showed new orders in contraction, but prices paid rising quite fast. That looks stagflationary to me.
Well, we've been rattling on about this for a couple of years, frankly. I suppose if you say it long enough, it'll happen. But I think there's a very real risk that you get this protracted slowdown, which is, whether growth goes to zero or just stays very, very tepid, that's academic in my mind. The fact is that you have high prices remaining at about 4% in my head on just the consumer price index, and the output slowing because the credit crunch will hit, and that will form a form of stagflation, which is going to polarize U.S. society going into the elections even more.
Will, do you worry about stagflation? Is this something we should be thinking about?
Yeah, I'll actually answer your last two questions, if you don't mind. So on the stagflation, we always have to be worried about it, but I personally think it's a low odds likelihood because like I said, I do think the Fed has been tightening very aggressively, both with rate hikes, which discourages banks from lending, and we're seeing, commercial bank credit growth has flatlined. The Fed is contracting its balance sheet. So on the whole, money supply is contracting. Yes, there's supply issues, and money supply is just one of the components of inflation. But given how aggressively the Fed has been tightening, I have a hard time seeing inflation persisting for a very long time. Now, I mean, of course, it can be stubborn for a year or two, and I could be wrong. So that's not a high odds likelihood for me. On your question about forward guidance, the Fed used forward guidance very heavily earlier in this cycle, and I don't think it's using it as much right now for two reasons. The first is there might be a couple of bankers out there that might punch them in the face if they do this again. Do you remember we're not even thinking about hiking rates? It was about that time that a few of the banks that are now in the headlines were buying long duration treasuries and mortgage-backed securities because there was no risk of their short-term funding costs going up because they're not thinking about raising rates. And of course, now we've had quite a few rate hikes. So I think part of it is the Fed is like, okay, now let's back off on that a little bit. And then the other reason is just because the outlook is less certain. They're getting toward a turning point, whether it's a pause or a pivot, they're getting somewhere near probably a point where they adjust policy, and they're wanting to take it slow. I mean, the situation is not clearly arguing for more rate hikes. It's not clearly arguing for rate cuts or a pause, and so they want to kind of take it one day at a time.
Now, the Fed's also going to be raising rates as we've got a banking crisis which doesn't seem to have abated yet, although JP Morgan CEO Jamie Dimon said that it was pretty well over. You look at the markets today, it doesn't appear to be over yet. What is the risk that this starts also affecting the economy because maybe credit gets squeezed, banks are less willing to lend, we may see more regulatory action against them? Is this going to have an effect on the real economy?
Dog's breakfast. It's going to be awful because the regulators don't really come out of the banking business sector, so they don't really know what they're doing. And because of correspondent banking relationships, you can't just sort of say, well, the little guys can do their own thing and the big guys do their own thing. They're all interconnected because of correspondent banking relationships where the big guys lend to the little guys and vice versa and all that. So it's horribly interconnected. And I'm afraid that especially when the little guys at the grassroots level in Des Moines, Iowa, or Eugene, Oregon, or Boise, Idaho, decide that they're not going to lend to the local property market, I'm afraid that's then where the contagion effect starts. Oh dear, they're not lending to my sector here in Eugene. What happens to the guys over in New York City or in Boise or in Wisconsin?
Well, how do you see this feeding through to the real economy, if at all?
I concur. I mean, basically, we're in agreement here. The banks are interconnected in part because of the lending to each other, but also just because they're all facing the same yield curve that is flat or inverted. There's if your business is borrowing short and lending long, you're not that incentivized to do it at the moment, and at the same time, your funding costs are going up, not just because of rate hikes, but because people are starting to wake up to the fact that they can get higher yields in money markets, and they're starting to pull money out. Now, the way I've described this is just anecdotally thinking about myself. I mean, changing banks is really annoying. So if you're at a big bank, you're probably not going to pull all your money out and open up a new bank account, or you may not because it's a hassle. But I'll tell you what I've done is I used to be a little bit casual about having some extra cash in the bank that wasn't earning any interest because opportunity cost wasn't that high. But now that I can earn 5% on money markets, I manage my cash levels a little bit better, and I only keep what I need in my checking account for the next few months and put everything else in T-bills. And so I think in that way, even the big banks are seeing deposit flight into money markets, and that's raising their funding costs. And so yeah, it's going to affect the real economy. And in my opinion, it already is. We're already seeing it.
Okay. Let's turn our attention to Hong Kong, because Hong Kong's economy has exited recession. It expanded 2.7% year on year in the first 3 months of 2023. That follows 4 consecutive quarters of contraction. It also beat economists' forecasts of a 0.5% expansion. Also a big improvement on the 4.2% contraction that we saw in the fourth quarter. Enzio, what do you make of this data? It seems to be fueled by a bit of a spending boom, doesn't it?
Yeah, it's a spending boom, but I think it's a short-lived one. I'm more concerned about something deeper, more pervasive, that I call dirigiste capitalism creeping into Hong Kong. We had it with the State Council in China, which understandably steers China's economy. That's how the system works over there. But now what we're seeing increasingly is our own leaders here saying that they want to incentivize growth by having a moderately liberal fiscal stance. In other words, let's issue more consumption vouchers. Let's have more happy Hong Kong and movements like that. I find that as a Hayekian, last student of von Hayek's, very, very disturbing to see that the free market is becoming replaced by better than the markets can themselves. In other words, they're yet again emulating China. I'm not knocking China in any way. I think what they've done is fantastic. I just don't know whether it's applicable and necessary in Hong Kong.
I mean, Hong Kong was known for its sort of laissez-faire approach to the economy, wasn't it? The market dictated things. I mean, this is quite
cartels being laissez-faire, yeah, but not so laissez-faire, but very fair, absolutely.
Well, I wonder... Sorry, carry on.
I was just going to say, the other day I saw a big bulletin board, at the bus stop for Hong Kong's new minimum wage. And then I turned around and there's a consumption voucher. And the road to serfdom also came to my mind, Enzio.
I don't want to sort of cast a cloud over this, but I'm wondering, is it really that great, though, when you compare that, the base effect really should give us quite a big boost, because a year ago the economy contracted 3.9%. I'm actually wondering if you take that into account, maybe the figure isn't so great after all.
Well, I think that there are a lot of structural problems, as we all know, in Hong Kong itself. I mean, I've always maintained that we're the water skier off the back of China's economy. I, for one, don't think that China's growth is robust. I think that private consumption there is quite wobbly because of income insecurity in China itself. And if China doesn't really boom, then it's very difficult how we, the small neighbor who rely on everything from China, food, water, etc., tourists, how we can then flourish when China isn't really flourishing, and I don't think will for some time yet.
Are you worried about the unbalanced nature of the economy on the mainland? Because the markets, investors in the markets don't seem to be too convinced at the moment. We saw obviously the manufacturing sector in the latest PMI data slip into contraction, although the services sector seems to be doing quite well. But what happens when all this revenge spending comes to an end, which it always inevitably does?
Well, I just felt Will's thoughts, but I mean, mine is that China is not a Lazarus. In other words, it's not going to awaken from the dead and all of a sudden spring to life in a sprightly fashion. Its economic time is characterized by an excess supply of money, but also by an excess supply of goods. That's kind of where Japan was stuck for many, many years. And I'm afraid that they're going to have to, it'll take quite a bit of skill to get China out of that rut. I think they will because they're very pragmatic people, but I think it's not going to be a fast, easy process. I think Hong Kong is going to then end up similarly with some sort of false dawns, a little bit of mirage growth going on, but not the real stuff.
Well, what are your thoughts on the mainland?
I was just in Beijing, actually, and just completely anecdotally, I flew in from Tokyo to Beijing, paid a stupid amount for that ticket, and then the flight was about 10 to 15% full. It was a Dreamliner with like 30 people on it, and then the airport was empty when I arrived. So that was surprising to me. But then when I got on the plane to come to Hong Kong, you could not fit another person on the plane. It was packed, and the airport had a few more people. So, it seems to me like, in terms of the pent-up demand, my best guess is that it's still to come. Feels like Hong Kong is one of the first places to experience it, and that's probably partly behind the stronger GDP numbers. But it seems to be taking longer for China to resume travel to Japan, to Europe, and whatnot. And that may just be because, people don't plan international travel next week unless it's a business trip. And so it may just be a few months. So I think a lot of the pent-up demand for travel and whatnot is still to come. When it comes to manufacturing and whatnot, I think the difficulty there, of course, is that if I'm right that we're heading into a recession in the U.S., then it's going to be difficult for China's for global manufacturing to do all that well.
Okay, well, thank you both very much for your thoughts there. You heard there Will Denyer, who is US economist at Gavekal, and Enzio Von Pfeil, who is a capital preservation specialist for individuals.
Peter Lewis's Money Talk.
I'm joined now by Ruchir Desai, who is fund manager at Asia Frontier Capital. Good morning, Ruchir.
Good morning, Peter. Thank you for having me.
You're very welcome. So tell me a bit about the frontier markets and particularly how they're holding up compared to all the international considerations, all the geopolitical situations that are going on around the world. What's the performance like?
Well, actually, if you look at frontier markets, and more specifically frontier markets in Asia is what we focus on, many of these Asian frontier markets have started the year off pretty strong given what's going on globally with talk about interest rates and inflation and the U.S. banking crisis, etc. For example, the Iraqi market is up more than 40% in U.S. dollar terms. Sri Lanka's up about 20% in dollar terms, and Kazakhstan's up about 10 or 11%. So pretty strong start across the board, pretty much across the board for most Asian frontier markets. And that's because of the fact that many of these markets are, I would say, less correlated from some of these events, such as the US banking crisis or the European banking crisis. So it doesn't really affect what happens, say, in Bangladesh or Vietnam or Sri Lanka, from that matter, especially in the banking sector, because the banks in our universe are very domestic focused. They focus on the domestic economy with traditional lending and deposit products. And also, just to add to that, the amount of credit in the economy in our markets is still very low. So, loan penetration in our markets is extremely low compared to, say, the US or Europe. Mm-hmm. So again, there's very less risk of contagion in these economies if something happens, say, to a smaller US bank or a larger European bank.
And how are they going to be affected by the Fed, which is going to raise interest rates almost certainly by 25 basis points tomorrow? Some people think that may be the end of the cycle, others not so sure. What sort of impact does that have on the frontier markets?
Right. So I think given what's happened in the US with the Fed raising rates since last March, I think that's impacted pretty much every market globally. I don't think any market has been averse to not being impacted by it. So interest rates have also risen in our markets quite significantly. But just to add to that, I think central banks in our universe, the central banks in the Asian frontier markets have been very aggressive in raising interest rates because inflation was already picking up quite significantly even before US inflation started picking up. So, for example, central banks in Pakistan, Sri Lanka and Kazakhstan have been very aggressive. They raise interest rates by significantly more than the Fed. Interest rates in Sri Lanka have gone up by about 10% in the last 1 year. Interest rates in Pakistan are about 21% and in Kazakhstan is about 17%. So pretty aggressive interest rate hikes from many of these central banks. So I think we are given, maybe the Fed raises tomorrow or not, and maybe they're done or not, but I think in terms of the headwinds from inflation interest rates on Asian frontier markets, I think we are beyond that curve now. So I think we've passed the worst in terms of those headwinds impacting the economy and also investor sentiment.
And is inflation under control? We know a couple of places where it's been a crisis. Sri Lanka, obviously, one of them. Pakistan has the highest inflation rate now in the region. But what about elsewhere? Have central banks succeeded in getting control of inflation?
Yeah, it's really it's pretty diverse across the board. Of course, like you mentioned, Pakistan and Sri Lanka have very high inflation rates. But for example, Vietnam, inflation is pretty much under control. It's between 3.5% to 4%, which is quite manageable given what's going on in other markets, even for example, in the US as well. And the central bank in Vietnam has raised interest rates because of the fact that they're very trade dependent and they have to manage the currency as well. So they've been aggressive in raising interest rates as well. But inflation is still not as high as, say, Pakistan or Sri Lanka also, or US for that matter. And yeah, also, for example, Kazakhstan has seen a high inflation, but other markets like Georgia, which is also part of a universe, has seen inflation coming off quite significantly. Inflation for the month of March was about 5% compared to 10% last year, so it's coming off. So it really depends on the market. But broadly, I would say, we are, like I said in my earlier comment as well, we are beyond these headwinds because inflation is kind of trending down now. For example, in Sri Lanka, inflation was at about 70%, I believe, at the end of last year. Now it's about 35% for the month of April. So trending down. I think it'll continue to trend down because interest rates have risen. You get the high base impact as well. The currencies have depreciated, which makes imports more expensive. So overall, I mean, I'm more positive on the inflation outlook on our markets going into 2024.
Mm. And another big trend that's going on around the region is the shifting supply chains, with manufacturers moving out of China into other countries. Where are the beneficiaries amongst the frontier markets in Asia?
There are a few beneficiaries in our universe within the Asian frontier market universe, but I would say the biggest beneficiary, not just in our universe, but I would say the biggest beneficiary in Asia at least is Vietnam by far. I mean, if you look at the numbers in terms of foreign direct investments coming into Vietnam, they've been about $20 billion a year consistently over the last 5 or 6 years at about 6% of GDP. And most of this FDI is going into the manufacturing sector, and this manufacturing sector is basically producing goods and products for the export market, especially the US and Europe. And clearly, Vietnam has been a clear beneficiary of that. For example, their exports to the US from the beginning of 2018 to probably last month have doubled on a monthly basis definitely because of the trade tensions between China and the US. So Vietnam has become a very important trade partner for the US, especially in the last 5 years. And besides that as well, I think over the last decade, Vietnam's exports have grown cumulatively by about 13%. I don't think any other smaller economy in Asia has done such a tremendous job in terms of export growth and building up their export base like Vietnam. But besides Vietnam, I would say Bangladesh is also doing quite well, but particularly in the garment sector. So Bangladesh is very focused as of now on the garment sector. Maybe in the future they diversify into other products, but right now garments is their strong point. They've become the second biggest garment exporter globally after China. They have the second highest market share in the US for garment imports. So they've done very well over there. So again, they've also seen a pretty good growth in the garment exports over the last decade or so. And even over the last 6 or 7 months, despite the stock of slow growth in the US and Europe, their exports haven't really come off a cliff. I mean, in the last 12 months, exports have grown about 14.5%. And for the month of March, exports were down about 2.5%. So they're not really falling off a cliff. Yes, there could be some softness, but I'm not so concerned about slow export growth in Bangladesh and Vietnam for the next couple of quarters. I mean, if the US and Europe slows down, of course there'll be an impact on Bangladesh and Vietnam in terms of the export growth. But I'm looking at a more longer term trend over here. And the longer term trend is very much in their favor because of the fact that many of the companies are moving out of China and other high cost locations into Bangladesh and Vietnam.
What about some of the Central Asian countries? There's also obviously a shift of supply chains out of Russia. Are the Central Asian countries benefiting from that?
Right, that's a good point, actually. Central Asian countries are benefiting quite a bit, especially in the last year since the conflict or war in Ukraine happened last February. So many countries like Georgia, Kazakhstan, Uzbekistan have benefited a lot. I think one clear beneficiary in Central Asia or in the region has been Georgia. They've benefited significantly from various avenues. For example, they've seen a large influx of longer-term visitors from Russia, from Belarus, and also from Ukraine coming into the country. So that's really helped their tourism revenues rise significantly. So I think it was one of the first few countries globally to go back to pre-pandemic levels of tourism revenues a couple of months ago. They've seen high remittance inflows because all the Russians and Ukrainians are bringing their capital with them, and they stay long-term in the country. They've also seen an influx of because of the human capital coming in. They've seen pretty well-educated and strong professionals coming into the country. It really helps their economy in terms of human capital as well, and also helps their exports also, because I think a lot of the trade routes which are going via Russia from east to west are now transiting via Kazakhstan, Uzbekistan, and Georgia. So that's really helping these countries. For example, the biggest port in Georgia on the Black Sea coast is now operating at full capacity. So there's no capacity in the port because of these transit routes doing so well. So yes, they're really benefiting. Even in, for example, Kazakhstan, Uzbekistan have seen influx of people from Russia. They've seen remittance increases and exports increase. So I think this is another trend to watch, because I don't think the sanctions on Russia are going to go away anytime soon, even if the conflict comes to some kind of stalemate or some kind of end, because these sanctions are here to stay. And I think this region will benefit a lot over the next 5 or 6 years. That's something to keep a watch on.
And what about tourism? You mentioned that a bit earlier. Is that picking up in countries like Cambodia and Vietnam and Sri Lanka?
Absolutely. I think tourism is making a very strong comeback across our markets, especially in Vietnam. Vietnam's tourist arrival numbers for the month of March were about back to 70% of pre-pandemic arrivals, which is pretty strong. They're doing almost 1 million tourists a month now, which is fantastic, given that they just opened up about a year ago. And that's really helping the economy, because this year will be a bit of a softer year for Vietnam's economy, given that they're very trade dependent and exports are kind of weak. First quarter GDP growth was about 3.2%, which was below expectations. So I think the tourism sector will really help them support GDP growth this year. And also Sri Lanka is seeing a bit of a rebound as well, especially now they've got some political stability into the country. So tourist arrivals for the last few months have been back to about 60% of pre-pandemic levels. So again, I think you're seeing a lot of tourism pick up in other parts of Asia, and that's really also helping our markets as well. So a big support for these economies.
And what are valuations like across the frontier markets?
Very attractive, actually. So, for example, for our fund itself, the AFC Asia Frontier Fund, valuations, the PE ratio is at its all-time low, about 6.9 times. So it's never been so low.
6.9 times.
Absolutely. So
Wow.
It just shows the value in our markets at this point in time. And even across the board, if you look at, for example, Sri Lanka's about 6 times, Pakistan's about 4 times. Even Vietnam, which is a very attractive market, has traded at a forward P multiple for Vietnam is about 10 times. So it's a very attractive valuation at this point in time. And on a bottom-up basis, the companies are perfectly fine. The companies we hold are blue-chip companies. They have very strong ROEs of more than 20%. Earnings growth over the last 3 years has been about 20%. And fundamentally, okay, so it's just that once the macro headwinds that the global economy faces in terms of interest rates and inflation, I think once that turns, I think the Asian frontier markets are very well primed for a strong re-rating over the next 6 or 12 months.
And one market in particular I wanted to ask you about, because we have listeners who are interested in it. You mentioned it earlier, Vietnam. What's the outlook for both Vietnam's economy and also its stock market?
Right, so I'll kind of split that up into 2 parts. So the short term and the medium to long term. I would say the short term, that is this year, Vietnam's economy is going to face some headwinds. because they're very export dependent. Exports are about 100% of GDP, so a very trade dependent economy. And of course, if the US and Europe slow down, their exports will take a hit, and that affects the economy as well, and also domestic consumption. So in the first quarter, GDP growth was about 3.2%, which was below estimates. So I would be very happy if they even do 5% GDP growth this year, given the headwinds that the global economy faces, especially the export sector. But besides that, I think they've also had to raise interest rates last year because of what the Fed has been doing. So the State Bank of Vietnam raised interest rates by 200 basis points in a matter of 2 months, last September and last October. They cut by 25 basis points at the end of March, but it's still high. And that's affected sentiment in terms of just the stock market sentiment and also the sentiment in the real estate sector, because people can't take out mortgage loans so easily, or can't take out loans for their capacity expansion so easily. And besides that, the government has kind of cracked down on the property sector in terms of the corporate bonds, which the real estate companies were using corporate bonds to raise capital. That has been kind of cracked down by the government, and that's also affected sentiment. So that's another headwind for the economy. So short term, I think this year would kind of be softer for Vietnam compared to the kind of growth rates that we've seen in the last few years of 7% GDP growth, or 6 or 7% GDP growth. But I think looking beyond 2023, once things stabilize in terms of global interest rates, as also inflation and interest rates in Vietnam, exports kind of start picking up again, domestic consumption should recover as well. Plus the longer term trend of the manufacturing shift into Vietnam, that's a big key. I think that's not going to change anytime soon. So that's going to continue happening even for this year. I think the foreign direct investment numbers up to April of this year have been pretty strong. So that's not changing from any angle. So I think beyond 2023, if you look at all the other important factors like the manufacturing shift, like the demographics, domestic consumption, the rise of exports, I think it should help Vietnam go back to about 6% plus GDP growth. And given where valuations are right now at 10 times, I think this is a good opportunity to look at Vietnam from a longer term perspective.
Ruchir, thank you very much indeed. That's Ruchir Desai, who is fund manager at Asia Frontier Capital. Thank you very much for listening this morning. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. It's Fed Day tomorrow. Joining me to discuss the latest monetary policy decision from the US Central Bank are Andrew Ferris, the CEO of Economist Advisory, and Simon Kavanagh, who is partner at BDA Partners. And with a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. Please join me again tomorrow.
Money Talk